Hi, welcome to the Inventory Management Masterclass with me and my co-host, David. Hi, David. How are you?
Hi, everybody. Good to see you.
I'm so glad that you are here. And today we'll be going through a lot of stuff for inventory in detail. It's going to be an exciting session today. So let's start by taking a look at what we are going to cover. So what we are going to cover is inventory versus fixed assets. So basically understanding and making sure that all of us are on the right page when we talk about what is inventory. Then we will look at inventory valuation methods. We will spend some time looking at cost of goods sold and looking at hidden inventory cost and how can they impact your inventory management. And inventory costing can be impacted quite significantly with them as well. And we will look at inventory control methods and techniques, which will include just-in-time inventory, ABC analysis of inventory, FSN analysis, also known as fast, slow-moving, and not-moving analysis, reorder points, economic order quantity, and how to calculate it. And we will look at inventory turnover ratio. The objective today is to understand all these control methods and techniques and the valuation methods in order to make sure that we are tracking our inventory the right way. So, David, did you know that in US alone, right, uh, more than 1.1 trillion worth of inventory is just sitting in warehouses, and the average ratio of inventory to sales is about 1:1.3, and other geographies across the world have similar or even worse numbers.
I did not know that at all. That sounds insane to have so much inventory just sitting there.
Yeah, and half of the businesses that have inventory use any kind of inventory control method or any kind of inventory management software. And the objective of this session is to get everybody up to date with all the methods and techniques that you can use to cut down on all these inventory expenditures that you're making without even knowing about it. So, David, before we jump into what is inventory, what is your understanding of inventory?
Well, it's just stuff, I guess, inside a warehouse that you take out and you sell. So I think items, physical items, and you just buy them, sell them, and hopefully make money. I think that's the key thing, right? Everyone wants to make money off them.
Yeah. The nail on the head there with the last point, which is making money out of them. But it is important to make the distinction between making money regularly as something that you sell or by making money by disposing of something. So, for example, right? So let's say that we are selling something like like a CD, correct? Now, for selling a CD which has got some software on it, right? You will need a machine maybe that does the packaging for the CD, correct? Is that machine inventory or not?
I think that would be a fixed asset, right? That's your stuff there, your items, your machines, your trucks. They all have depreciation, I guess, over time. But I always wondered about the smaller items, though. You know, like what's it called? You have the machine that packages it all, but then you have the what's it called? The people that do the taping and packaging. You know, like the not the tape itself, but the actual rollers that do the tape rollers. Maybe the hammers, or if you have a crate, the hammers with the nails. I mean, are the hammers and those items also fixed assets, or what are they?
So you can call, I mean, they would not be considered inventory, and we will shortly see why, right? Because they're not getting consumed in the process of selling. They are there. You can reuse them and keep using them. So they have a useful life. Their useful life may be a lot lesser than, say, a bigger equipment, right? But they still have a life, and we use them over a period of that time, which kind of differentiates it from inventory, unless I am selling those hammers as part of the package, that is. So let's look at a definition of inventory, right? So what is inventory? Anything that you buy to sell would be considered inventory. So if you are in trading or import export and you're buying anything to sell it further down the line, then it should be considered inventory. Anything that you buy to consume for a finished good. So if I am manufacturing something, like say for example, uh, a desktop, right? I buy the RAM, the hard disk, the keyboard, etc. separately, and then I don't ever sell the keyboards, for example, or I don't sell the hard disk separately, but I only sell desktops. In this case, the desktop is a finished good, but everything that goes into building that desktop is to be considered inventory. Then packaging material. So if I am packing my stuff in something, right, maybe in boxes or in gunny bags or plastic wrappers or whatever, right, I would want to keep a count of that, and it is something that gets consumed with every sale that I do. For example, when I'm selling something that is packaged in a box, then the package then the packing itself is to be considered inventory. And then anything that we produce to sell, which is finished goods. So any finished goods that you are building or manufacturing or assembling should be considered inventory. David, what are your inputs on that?
Yeah.
Any deviations that you have observed?
I don't think so. It's just sometimes the packing material becomes the actual product. Like, for example, those styrofoam little things, those items. My daughter loves them. She goes and she rips them open. She likes it more than the toy we get her that came with a box. And then she'll make the box into something else. So the packaging material actually becomes the product in that aspect, and I guess that's why it's part of inventory, but I thought that's also interesting.
Yeah, I mean, so for example, I mean, if you're selling something, right, and you are always packing that item and then selling it off, then you are in effect creating an assembly with all the finished goods that has got all the raw materials and the packing material as well. So when you sell anything, that package count goes down, and it is directly related to your selling, right? It is something that is getting consumed every time you are making a sale, and that is where it and that is why it is counted or considered inventory. However, if you're using a machine to do the packing for you, that machine is not getting consumed, or a unit of the machine is not getting consumed every time that you're packing something, because you will use that machine to pack another box and then another box after that. So those machines are not inventory; they will be fixed assets.
Just thinking, that a lot of people maybe don't need to keep
Delaying your order fulfillment, which is not a good thing in any case. Similarly, any furniture that you are using, for example, or any even stationery, etc., that you might be using, or even if you're consuming it, and the use of that particular item is obviously at the end of the day to produce the finished good, but if it is not getting consumed in every single uh, sale that you are making, then it is not an inventory, it is a fixed asset or an expense, but I wouldn't consider it inventory. So it should not be, and that differentiation is necessary. Now, sometimes people ask that, okay, so I sell online training courses, for example, or we sell software. So should that be considered inventory? What do you think, David?
I'm just thinking, you may want to keep track of it if there's serial number, but not really. I don't think it would be considered inventory, would it? I mean, it's a non-track product. You should have unlimited amounts of your software. All you have to do is just sell it and they're downloading it. So it's not something that you have to keep track of. Unless it has a product key that you have to keep track of each product key and who owns that product key. then maybe you need to have inventory management to keep track of. But again, you have unlimited quantity. You're just keeping track of a serial number, more or less, not really the quantity. So I would say no.
Yeah, I mean, it's an interesting question to ponder over. It depends on the different use cases. And the next slide will help us kind of answer that question. So, is it trackable or countable? Correct. So, if I'm selling software as a service, right? And once I have the software on the cloud, anyone can come and buy it, right? I'm not keeping a track of how many, I mean, I am keeping a track of how many subscriptions I have, but it's there. So I wouldn't count any product that is being offered as software as a service as an inventory. It is a non-tracked product or a non-inventory item, which I am selling, correct? However, as David rightly pointed out, if I have got serial numbers, or for example, if I am selling software on a CD, for example, right? I don't know who does that anymore, but yeah, I mean, or if I have to, uh, I mean, basically I'm consuming something to sell that item, then I would want to track that as an inventory. Or if I want to track it by serial or batch number. Normally, batch number for software doesn't make a lot of sense, but serial numbers or key numbers is something that you would want to keep a track of because you're generating those key numbers somewhere, correct? And then those key numbers are being distributed to your consumer. So you may want to tag that there. Now, whether you consider it as an inventory or not should ideally be down to whether you can actually count it or not. And if you are able to count it and you want to keep track of it separately, then you may choose to track it as inventory, but you can also choose to do like just a simple tagging of the inventory, a simple tagging for serial number against each invoice that you are generating, for example, and use that and not track your software product as an inventory. So, but that is for online software or where there is no physical component involved. If there is a physical component involved for selling your software, then it should ideally be tracked as inventory. For example, CDs. Okay. Now, where does inventory appear on the balance sheet? So it would appear under current assets. Why? Because this is, I mean, all inventory is an asset. It's not a fixed asset. So we need to differentiate between fixed assets and current assets. I mean, assets could be anything. I mean, assets is everything that you have in your organization right now, which would include account receivables and total inventory that you have and so on. Whereas fixed assets are slightly different. And so when you look at your balance sheet, you can see the value of your inventory shown there. And inventory is never depreciated because you are going to consume it within a shorter amount of time. Now, okay, so there is a question from Kenny that why machine is not considered inventory. The machine will be broken in 10 years or less. Okay. So so in this case, what we should do is we should consider machine as a fixed asset with a useful life of 10 years. And then what is happening is that every time you're making a sale, the machine is not being sold, right? Or it is not getting fully consumed. You are obviously taking away some usefulness of the machine as you keep using it. But even if you don't sell, right, maybe, I mean, the machine can still break down after 10 years, correct? Or even if you're not using the machine, its useful life is 10 years, and after 10 years, it will probably not work anymore, and you will have to get a new one. So, you should actually put that as a fixed asset, and that will allow you to post depreciation of that particular machine into your accounts under fixed asset depreciation instead of using it as inventory. So you are basically spreading the breakdown of that machinery over 10 years, and every year, you will have a certain amount of depreciation going in. David, what are your inputs on that?
Yeah, I agree. You would have it as a fixed asset. It would depreciate over 10 years. And then I guess you can also sell an asset as well, though, later on, right? So that would either be sold or scrapped based upon the situation. If it's broken down, then you may just take all the parts and sell it and scrap it. But yeah, it's an accounting. It depreciates over that period of time, over that life, and then it's off the books, more or less. It's depreciated completely. So yeah, I mean, that's the purpose of the machine. Just, something.
Thank you, David. So let's continue with this. So now we know that inventory appears under current assets on the balance sheet, right? And you would see a value assigned to that inventory. But how do you get that value? Now, so let's take a look at that. Okay, how do you measure inventory value? That's the next item on the agenda. And there are three popular methods for measuring inventory value. They are first in, first out, last in, first out, and average cost value. David, why do we need different methods? Why can't I just multiply the purchase price with the inventory that I buy and use that for my inventory valuation?
Because this, I guess it'll determine, once you sell the goods, how much your inventory is reducing in value. So for example, first in, first out, I bought it at a certain price. So $30, my last time I purchased was $30. And then I placed an order and I sold it, then the $30 should be reduced from my inventory. Whereas last in, first out, the first time I ordered that item, or the oldest one, say I bought it for $10 and I sold it, then $10 will be reduced from my inventory. And so this all determines how much inventory I have in the system. If I do it poorly, or I just do it randomly, I won't know how much value is actually in my, inventory value. I have to choose a method. I can't say, okay, first in, first out today, last in, first out tomorrow. Maybe some random one I'll select off the corner. Maybe.
Thanks, David. So what we have to understand is that inventory is always in a state of flux. And the value of inventory that you are purchasing is what controls the inventory valuation that you would see in your balance sheet. So inventory value is not determined by the price at which you sell. It is always determined by the price at which you buy it. And when you buy items, you don't only buy items, right? You keep selling them, and then you refurbish or restock those items. And there is no guarantee that the price for the restock will be the same as the price for the first batch that you bought. And therefore, there is a difference. And eventually, over a period of time, you will have inventory with different purchase costs sitting in your warehouse. And when that happens, and you sell something from this, you have to you have to follow one method, which is either first in or last in or average. Why? Because otherwise, you have no system of knowing that, okay, after I sell any inventory, then which inventory was that? Was it the one that I bought at $10, or was it the one that I bought at $20, or was it the one that I bought at $30 or whatever, right? And let's take a look at that example here, right? So in the company ABC, right, if I buy 10 units for $100 at $10 each, and then I buy another 20 units at $15 each, and then I buy another 10 units at $20 each, right? Then my total inventory is 40 units, and my total inventory value is $600. Now, the total inventory value at this stage will be the same in FIFO, LIFO, and average cost. But the complication arises as soon as you sell something. So let's say that I sell 5 units. Then what happens? I have 35 units. That number is there. But these 5 units that I sold off, what was the value of these 5? I don't know till I determine a system or till I lock in a system that, okay, this is the system on which I will determine whenever any inventory goes out as to the value of that inventory. So with first in, first out, when 5 units go, they go from the first 10 that I bought, which was at $10 each. So the remaining inventory value is $550, because that 5 into 10, 50 is what I subtract from my total inventory value. However, with last in, first out, you can see the calculation is different here, because the 5 units are going from the last 10 units, which we bought at $20 each. And therefore, my inventory value decreases by $100 here instead of 50. And with average cost, the difference is that I first calculate the average cost of my inventory based on total number of units and total inventory value before I start making the sale. And then I multiply the number of units sold with that average value. And with average cost, you will see that the number is $525. Now, there is something interesting here. Do you observe? What are your observations on these three methods of calculation here, David?
It affects your remaining inventory value. So based upon which one you select, it could really change how the value of your inventory inside the system. So if I buy something in the past that was very expensive, and that was, what's it called? That was my last in, then I consume it, I may actually show a loss. For example, if I sell it at a cheaper price, where my overall average, so for example, if I have a huge amount of money, last in, first out, and I bought it was very expensive, and then I do last in, first out, then my inventory value can reduce dramatically. Where if I'm buying my items first in, first out is very cheap, then it may not have an effect on my inventory. For example, with FIFO here, I see $550. With LIFO, I see $500. And with average cost, it's $525. So with FIFO, it looks like my stock value is a lot more. With LIFO, it's a lot less. And average cost, well, it's average. It's somewhere in the middle.
Yeah. So that's the thing, right? Now, the interesting thing here is that, depending, okay, let me put it this way. Price increases over time. That's inflation, right? The value of things or the cost of things is going to increase over time, correct? So now if you want to show more assets in your balance sheet, if your objective, if you're looking for a higher asset value, then you should go with FIFO. Why? Because with FIFO, because you are always removing the inventory that came in first, more often than not, the value of that inventory will be lesser than the value of the inventory that you bought later. So your inventory asset will always be at a higher number. With LIFO, your remaining inventory value goes down, right? But what it does is it also reduces your gross profit. Now, what is gross profit? Gross profit is basically your income minus your cost of goods sold, correct? And cost of goods sold is going to be higher for LIFO compared to FIFO. And we will see how. We will look at those calculations as well.
I was wondering.
Yeah, what were you wondering?
I was just wondering.
Does this methodology, FIFO, LIFO, and average cost, also apply to batches as well? Or batch management, batch products?
Yes, they do. So there are different schools of thought on that. So if I am running inventory with batch numbers, then I have the option of using FIFO, LIFO, and average cost for that. But the differentiation is that I can choose to do it within a batch or as the overall set and use the batch only for tracking the expiry and the origin and other details. So both methods are commonly used. I have not seen any major, I would say it's about 50-50, depends on your use case, right? If your batches are more strongly controlled, then you want to do it within the batch. But if it is not, if you don't want such strong control on your batches, then you can use batches only for tracking the origin and the batch number and the expiry date, etc. And the costing can be done outside overall on your product based on either FIFO or LIFO or average cost. One more thing, and I always get this wrong. So what is the correct pronunciation for this? Is it FIFO or FIFO? Or
I always heard it's FIFO.
Yeah, I keep hearing different things. So some people call it FIFO, some people call it FIFO. I hope I'm getting it right. If I'm not, please let me know. I mean, what's the right pronunciation that you have come across, or what's the right pronunciation according to you? Just leave a comment in the chat. Based on the number of so we can have a quick vote there, whether it is FIFO, so you can just put FAI, or you can put FEE, and we will know. I mean, we can do a count at the end, and then we will see which one is the right pronunciation according to majority of the people on the chat today. So now that we know how to calculate the value of inventory, the next topic that we are going to pick up is cost of goods sold. And inventory valuation and cost of goods sold is closely linked. Why do you think that is, David? Why do I make that statement? Inventory valuation and cost of goods sold are closely linked. Why do you think is that?
Inventory valuation and cost of goods sold. Because I'm assuming that whatever you sell the item for and whatever you buy the item for, the difference would be your profit. And then you would have your cost of goods sold as the cost. So if you do a different methodology like FIFO, LIFO, or moving average, it directly affects your cost of goods sold and your profit margin on that. So that's what I would think.
Absolutely, yes. Yeah, because cost of goods sold is basically the total cost that you incur for getting the product ready for sale. All right. So when I say getting a product ready for sale, we need to differentiate between indirect cost or cost that you may still be incurring for producing the product, but not used in direct sales. So let's understand that concept with an example, right? I mean, end of the day, every business's purpose is to sell something, right? I mean, every business is selling something. It may be inventory, it may not be inventory, right? And this concept of cost of goods sold is applicable for non-inventory items as well, equally applicable. There you just call it cost of sales. You don't call it cost of goods sold, but it's the same concept and it's the same methodology and the same calculation. And understanding this concept is important, because otherwise we may end up with a very weird looking profit and loss or an income statement, and you don't want to do that, right? So all the costs, all the different costs that a business is incurring, right, is eventually to be able to sell the product somewhere, right? I mean, you're not incurring all the cost and then, I mean, at the end of the day, the objective is to sell that item. So all my salary, all my office rent, electricity rent, the stationery, advertising, furnitures that I buy, and the assets that I have procured, everything ultimately boils down to helping me sell the item, correct? So by that logic, everything is cost of sales or cost of goods sold, but that's not the case. Now, and why? Because if you put everything under cost of goods sold in your financial report, then your auditor is not going to be happy, because as per AFRS or standard accounting practices or GAAP, etc., you're not supposed to put every single expense that you incur under cost of goods sold, but rather only expenses or costs that directly relate to the selling of the actual item. And David, what do you? I see that you want to say something. So yeah.
Oh no, I was thinking. Yes, you're right. And I was thinking about what you were talking about, cost of goods sold and the different methodologies as well. Because I remember, and sometimes there are cases where you may buy something at a very expensive price. You think it's a good price at the time, you buy it, and then the stock and the price all of a sudden crashes because someone floods the market. And then if you're doing FIFO, first in, first out, then you're still looking at your profit and loss, and you're still making a profit there. And then if you're doing LIFO, all of a sudden, maybe that product's actually more expensive than what you're selling it for. So you're losing money every time you sell it. And just think of these different types of methodologies and how that can affect your profit and loss and how you can see it and all that. And yeah, definitely for expenses like electricity, water, power, employment, employees, they would not be under cost of sales.
Yeah, they typically go and sit under expenses on your profit and loss statement, right? And let's try to look at this from the view of the just look at the term. It is cost of goods sold. So the sold part, or the term cost of sales part, is the important part, because what is happening is that everything that I'm doing may not be contributing directly to the sale here for a given period, right? Even if I did not make a single sale, right, I would still have to pay the office rent. I would still have to pay the electricity rent, right? All of those things will continue to happen. And that is why you should not just put that in under cost of sales. It should be typically under expenses, right? Now, what would be cost of sales then? Correct. For let's say that I sell 10 units, or actually, you know what, even better, let's jump to an example to understand that. Okay. Now, let's look at this example here. All right. So there's this company that buys laptops from suppliers and sells them from its website. All right. In the previous financial year, they had 50 laptops worth $25,000. That is your beginning inventory. And if you look at the formula, it's a big formula, so I won't go into the details. It's there, and we'll share the slide with you, so you can always refer to this later. But that's what you classify as the beginning inventory in this case. And then they purchased 100 laptops for $600 each. So now they have 150 laptops. All right. And then they sold 120 laptops during the course of the year. We are taking a very simple scenario here. So at the end of the year, now they have 30 laptops left. And they are not building laptops on their own. So they are buying it from somewhere. And let's say that the cost of shipping each laptop on an average is $5. And the cost of shipping the sold laptop or delivering the laptop to the customer is $10. So with those assumptions, right, let's look at the calculation here. Now we know what is the beginning inventory, which is 50 laptops. And therefore, the beginning inventory value is $25,000. Laptops purchased is 100 at 600. And therefore, my total sales for laptops sold is $120,000. Now, my closing inventory is my opening laptops plus the number of laptops I purchased minus the sold laptops, because that's what I end up with, which is 50 plus 100 minus 120. So I end up with 30 laptops here. Now, what is my closing inventory value? As we saw in the earlier example, we will have different numbers based on whether we use FIFO, LIFO, or average cost. Before I go any further, David, any questions?
Not real. It's a very, very complicated formula, but from what I can see, the inventory value really changes. Closing inventory value if you use FIFO, LIFO, or average cost. From what I can see, from 18,000 to 15,000 to 17,000, so it just completely changes based on which methodology, and can change your value of your inventory. And as you mentioned earlier, FIFO is showing a larger amount than LIFO or LIFO or FIFO, based upon how you pronounce it. So you can see it really does affect your books and everything, what you're reporting inside there.
Yeah, absolutely. So, as you can see, just like the earlier example, there is a difference based on which valuation method you use. And this is the valuation that we get based on the different methods here. Now, the next thing that we look at is the direct cost, because if we refer to this formula here, you will see, we have the beginning inventory value, we have the ending inventory value, we have the total inventory purchases. Now, what we are looking at is to calculate direct cost, or cost related directly to sales. So how many did we sell? We sold 120 laptops. All right. So if I look at my cost of shipping here for those 120 laptops, for FIFO or FIFO, it will be 1,550. How did we arrive at this? Let me talk about the numbers that are showing here. All right. So the 70 that you see here is the laptops that I sold. But I mean, you will have a question here, right? That, okay, I sold 120 laptops. So why am I putting 70 here? David, do you know the answer to that?
No idea. I'm waiting for the answer. I'm looking at it. Okay. 70, I guess, must be from the, what's it called? Because LIFO. So you bought 100 laptops and then you bought 50 originally. Then there's 50 from there, but 20. That means no idea. Looking forward to your answer.
All right. So yeah, this is where the difference in FIFO and LIFO comes into play, especially with the calculation of cost of goods sold. So if you remember, we had 50 laptops that we already were carrying over from the previous year. I sold 120 laptops, right? Now, out of those 120 with FIFO, how will that breakup look like? The 50 will be first sold from my existing capacity or the carryover inventory from previous year. And I did not have to pay any shipping to get those 50 inside because they were already there. So my cost of shipping for those 50 was 0. This is assuming that they were already there, and I've already accounted for that in my previous financial year and so on. So I'm not gonna carry this over here, right? So so out of the 120 that I sold, I only paid shipping of $5 for 70 of them. I did not pay it for the entire 120 or the entire 100 that I purchased. Correct. Therefore, I will take 70 into 5 here, which is the cost of getting those items shipped from my supplier to my warehouse. But when I ship it out, the $10 apply for each of the 120 that I ship out. Therefore, I take the cost of shipping for items that I sold plus the cost of delivering items that I have sold and add them to get my direct cost here. Now, if you look at direct costs for shipping for LIFO or LIFO, there is a difference. Now, with that understanding, David, would you like to take a shot at explaining the difference between the numbers that you look at direct cost for shipping for LIFO versus FIFO?
Sure. So those you're consuming, well, should this be LIFO or should this be FIFO? I'm just a little sorry. It's because the laptops that were purchased this year was 100 laptops, right? Correct. So first in, first out, the 100 would be consumed first, then times by the 5 for the shipping cost. The other 20 is already consumed because of the beginning laptops. So that means those 20, you don't have to pay the shipping. So you would just do the 100 times the 5 plus the 120 times 10 because you have to ship them out anyways. You have to ship them out to the customer. You can't say, oh, well, that was last year. You don't have to pay the shipping cost this year. No, you still have to pay it. So I take the 100, I times it by the 5, plus the 120 times 10 for the actual shipping now. I get 1,700. So based upon the different LIFO or FIFO, the cost changes accordingly.
Absolutely. So you got that absolutely right, David. Because with LIFO, out of the 120 that I sold, the last 100 that I got in, for which I paid my shipping, have to be taken into consideration. And then you add to that the cost of delivery, which is the same for both FIFO and LIFO, if you notice, right? I mean, the 120 into 10 does not change for either of them. Why? Because, hey, when you're delivering it, that cost is going to be there. You cannot avoid it. And that cost is directly related to your sales because that cost is leading to a sale ultimately, right? And that cost is occurring because of the sale. If there was no sale, you wouldn't have had this cost. Hence, cost of sales or cost of goods sold, right? So it will be a part of your cost of goods sold calculation. And similarly, when we look at average, then we see a different number. So would you like to take a shot at that, David, explaining the last number? How does it change for average?
All right. So we have the 1,700 divided by 150 times 120. Sorry. So you're taking the 70 or the 1,200 laptops plus the 50 laptops. Okay. And dividing it then by 150. Okay, because of course, so the $150 is from the 100 that you did the shipping for. So the 100 new ones that you received this year that you paid $5 shipping, you took that 100 and 150. Actually, no. What's it called? The 1,000. Oh, okay. Okay. So
back to the definition of average cost, right? I mean, average cost, how do you calculate average cost? The key is in the term average, right? First, you average out the total value for the total number of units that you have. Now, before I started selling something, my inventory was 50 that I had from last year and 100 that I bought this year. So a total of 150 units. And what was the total cost of shipping for both getting this in and getting the rest out? That would be 1200 plus 500. 1200 for shipping out the items for delivery and 500 for getting those 100 items in. So I take all of this together, I aggregate it, and then I divide it by the total number of units that I had to get the average shipping cost for each unit, which is 1700 by 150. And that gives me the unit cost of shipping, average unit cost of shipping, and I multiply that by the number of items that I sold, which is 120. And that gives me a third number, which is 1,360. Now, with these three numbers, when I calculate my cost of goods sold, then I get the value as 68,000 something for cost of goods sold in FIFO or FIFO. Then for LIFO, we get 71,000. And for average costing, we get 69,000 something. So just like how you saw in inventory valuation, right? The FIFO method versus the LIFO, I mean, FIFO and LIFO are the two extremes, and the average will always sit somewhere in between. Now, the question that people would have is that, okay, which one should I go for? So, David, what would you suggest people to go for here? I mean, what should a business go for? Should they go for FIFO, LIFO, or average?
Depends on what they want to show in their books. I mean, if I want a higher cost of goods sold, then LIFO. If I want my inventory to show more value, then I would do FIFO. Average, somewhere in between. That's what I want. Meaning my inventory will be somewhere in between and my cost of goods sold will be somewhere in between.
So, yeah, I mean, all those points are absolutely correct. And it would typically depend on a business's objective, and your accountant can advise you. But there are a couple of things that you should keep in mind. One is that LIFO is generally not used anywhere else in the world apart from the US. In fact, it is banned in some countries by governments and the accounting regulations. The reason for that is because with LIFO, you actually end up reducing your tax, because as you see, your cost of goods sold is highest with LIFO or LIFO. And with cost of goods sold being high, your profit automatically goes down. And because of that, your tax payable goes down. So, I mean, if you plan to pay less tax, then LIFO is the best option to go for. But yeah, I mean, please consult with your accountant and whether your country allows LIFO inventory reporting or not. I mean, that's something that you have to be absolutely certain of, and it is different for different countries, right? But most countries don't allow LIFO, right? And between FIFO and average cost, FIFO is the most preferred method. Why? Because as we saw with the calculations also, right? I mean, calculation of average cost can become very tricky, especially if you have a lot of ins and outs. Whereas FIFO, even if you don't have an inventory management system, you can track it in an Excel sheet. But average cost is super difficult to track even with Excel sheets or any kind of manual methods. and it's even harder to explain. So FIFO is generally what people go for, easier to track and more generally accepted across the world. LIFO is more common in the US, but again, depends on your objectives, and your accountant is the best person to advise you on which method to go for. Yeah, David, you were saying.
LIFO is preferred method in the US, or LIFO is the preferred? LIFO is the preferred method.
LIFO is preferred by most smaller companies, etc.
Okay.
So I wouldn't say the most preferred method in the US, but it is used in the US, right? Whereas FIFO, I mean, it's not allowed to be used in most of the countries at the moment.
In the US would try to reduce their taxes. So FIFO, I would always assume, yay, reduce tax, didn't make very much money.
Yeah, so
actually the state city.
So again, it depends on, I mean, if you want to show a good balance sheet, then you go for FIFO. If you want to show less profit and therefore reduce your taxes, then you can go for LIFO. But I mean, that's the outcome, right, of following these two methods. Again, this is assuming that prices increase over time. If prices start decreasing, then the reverse will happen, right? So, so yeah, I mean, you have to take that into consideration. My legal team is telling me that I should make a disclaimer that all of this is FYI, and please take consultation from your accountant, etc. So please do so. This is not legal advice. Okay, this is just our observations. Yeah. Okay, so now that we understand valuation and cost of goods sold, right? Let's move to next topic, which is hidden inventory cost. So the example that we took here was a pretty straightforward example, right? I mean, the only additional cost that we were considering was the shipping cost, which is quite easy to track and manage. But what about the hidden cost that we are not tracking, or that we are not aware of, or we don't even know exist? So, David, would you like to share some examples of and give some insight into these 5 different hidden inventory cost categories?
Oh yeah, definitely theft, wastage, and expiry could be a major pain. If all of a sudden your laptops disappear, it's wastage, or it expires. Like if you have medicine or food products and they just expire without being consumed, then it's just really a terrible waste. What's it called? Warehouse rent. Of course, you got to rent the warehouse unless you're doing drop ship method. You would have to have a warehouse to store the goods. Employees, but that's an expense that you would have to do. It's a cost, and it's a cost whether you pay or not. Electrical, water, power, all those wonderful things. Your internet, if you're using a, what's it called, a scanner or a barcode scanner, and you want to, or using a system to record your inventory, that's all important. Let's see, holding costs. Yeah, your fast moving costs or your slow moving products. All of a sudden you have one product that's been in there for centuries. You're going back there and saying, I didn't even know there was 8-track players, but we still have it in our inventory. What are we going to do with it? And probably some of you are listening to me, what the heck is an 8-track player? Showing you how old I am, or CDs and stuff like that. So these are all additional costs that are in there. Inventory holding costs, employees, yeah, all this stuff. Inventory carrying costs. Is that what, is that machinery, or is that what the people do at Amazon? They're carrying all the goods to the store or something like that? What is inventory carrying costs?
That's a good question. So let's talk about that first, and then we will look at each of these hidden costs and how to identify and track them, or at least take the first step in acknowledging that, okay, these costs exist and I need to account for them in my books and in my inventory cost calculation and my cost of sales or cost of goods sold calculation. And then we will be talking about how to control these costs. So inventory carrying costs are, so as I said earlier, right? I mean, if you remember, close to 1.1 trillion. So trillions of dollars of inventory is just sitting in warehouses. And the inventory to sales ratio is 1:1.3. So basically, for every $1 of sale that is happening, $1.3 of inventory sitting in your warehouse. it's not 1:1. I mean, if it was 1:1, that's the ideal place, right? But the average is 1:1.3. What does that mean? That means that people have got a lot of inventory just sitting there, right? It's not being sold. It is just adding to the overall cost of holding that inventory. Now, what are the different costs that would make your inventory cost balloon or shoot up, right? I mean, it's a combination of all these ordering and holding costs and everything, right? And now you have spent all of that money, and that inventory is now sitting in your warehouse. You're not selling it, and you're basically losing out on that money, right? I mean, if instead of buying that inventory, you would have invested that money in a bank or a mutual fund or wherever, right? Then you would have made some money out of that. But right now that money is locked, it is sitting, and it is probably going down in value for all that you know, right? I mean, that money is locked now. So that is what I meant by carrying cost. It basically, you are carrying that inventory and your money is locked in there. If you had invested that money somewhere else, then you would have gotten some interest. And that is what I mean by inventory carrying cost, or the opportunity cost of inventory, right? That opportunity is lost to make money elsewhere. So unless you are offsetting that investment, I mean, even the most simple thing, I mean, even if you just put it in a bank, you will get what, 1.5 to 3% return. So if you are never going to recover that money by selling that inventory off, then it is lost opportunity cost for you. And that is I mean, and I'm glad you asked this, because this is the most difficult one to track for most businesses, right? Now, what are these other costs? So ordering costs are pretty straightforward. It's an example of all the shipping costs, and the example that we saw earlier kind of included that, right? So shipping cost, if you are shipping it from overseas, then there'll be duty involved, octroi, 10 different kind of taxes that you have to just pay to get the goods to your warehouse, for example, right? Or if you're shipping it out, you will again have to bear those costs, freight charges, etc., etc. So these are ordering costs. When you order something, then you incur a cost, correct? Now, this ordering cost is something that will reduce with the volume, because this is, I mean, some part of the ordering cost will be fixed. Obviously, one part is your purchase price, which is going to be a function of the number of items you purchase. But then you also have these other fixed costs, like shipping or duty or octroi, or onboarding, or labor that you associate by labor costs associated in getting that item from, let's say, the harbor to your warehouse, right? I mean, it's the same thing, right? I mean, if you order 10 items on Amazon, correct, and if you order one item on Amazon, the shipping cost is going to be the same, unless you're using Amazon Prime, in which case you get it for free. So it's the same thing, right? I mean, so there are fixed costs and obviously increasing costs. So as you increase the volume, you reduce your average order costs per unit, kind of, and you can manage it that way. But this is the easiest one to track, actually, because you are seeing it associated with that particular item in your bills and expenses directly. The next up is inventory holding costs. So once you have an inventory in your warehouse, right, you are keeping it in your warehouse. Somebody would have been assigned to keep a track of that inventory item. Somebody would be going ahead and doing a cycle count from time to time. You are you have security in the house to make sure that nobody's stealing from you. There is rent for the warehouse, there is electricity that you have to pay, right? And all of these add up, and we need to attribute this to the inventory cost of sales by doing an averaging out of these costs, then doing a proper attribution by weighing the average of what is sold versus what is already in there, and then adding that to your cost of goods sold. Then stock out cost and shrinkage costs. So what is a stock out and shrinkage cost? Stock out is anytime you have to move an inventory out for whatever reason. So one reason could be replacements, right? So you sold something, but that had to be returned, or it had to be replaced. So now you have to do a replacement for that item. So the cost increases. Sorry, let me just grab some water. So the cost of that one item has increased because you had to carry out the replacement process. And that process, I mean, whatever that you do is not free of cost. I mean, there is always some cost associated with it. And capturing that and putting it on your books will allow you to get the right cost of goods sold, and hence will allow you to get the right view of your profit margins, which may actually be shrinking, but you don't really know about it because you're not tracking these costs. Shrinkage can happen because of theft or wastage or expiry. So I mean, it could be, I mean, there are multiple reasons for which you can have inventory shrinkage, wherein when you do an actual count of inventory and you compare it with your books, you see that there's a difference. And there are ways to control that also, and also to account for that, because every time you do a cycle count, then whatever inventory that you have lost is something that you can just pass as a stock adjustment into your system, and that is when it will get accounted for, right? And then obviously we talked about the carrying costs earlier. David, any questions?
That's a lot of costs. So very simply, you just have to calculate it. But it must be quite difficult to calculate all these costs without some sort of system or some sort of method. Excel sheets would probably, I'd go crazy. But so with all this and all this information, are there some cool reports or formulas that we can use to help calculate all this?
Yeah, absolutely. And that brings us to the next topic, which is inventory control and inventory control methods and techniques that we are going to look at, right? Now, what is inventory control? Okay. So we have all these different costs, that we saw. There are some which are obvious, like ordering cost and shipping cost. Then there are some which are not so obvious, correct? And if you were to try to calculate each one of these individually and separately, then it takes a lot of time and frankly a lot of effort, right? So but you should still spend some time doing that if it is offsetting the cost of the cost of manpower. If that is being offset by the cost of inventory that you end up reducing, then it is worth the effort, right? But even before doing going into a lot of detail about all these individual cost calculations and all, there are some high level things that you can do to see whether your inventory is performing the way that it should be. And you can take steps to control the inventory levels and the cost of the amount of money that you're spending on getting inventory, storing inventory, shipping it, and so on. And these are some of those steps here. So let's talk about the individual steps first. So first step is to forecast your inventory levels. Then you set reorder levels. You use an inventory management system instead of doing everything manually. So there is lesser chance of error, and you can do all the math and all the COGS calculation and valuation is done automatically instead of you having to do it in an Excel file. And then you pick the inventory control method which is right for your business by using one of the methods or techniques that we are going to talk about. So David, what are your views on the 4 steps of inventory control?
I think it's very important that you get this right. Use an inventory management system, because if you don't, then it can be very confusing. If someone updates it wrongly, then it can be quite bad and painful. Your reorder level, you have to calculate that correctly. If not, then you're talking about earlier about having too much product or too much inventory inside your warehouse. As you mentioned, 1.3 in the United States. So if you get the wrong reorder level and you buy too many, then your stock will increase, and that's lost, value there. That's a cost. Or if you do it too poorly, then all of a sudden you don't have any inventory in there, and then all of a sudden your customers are disappointed. So that's very important.
So I have a question for you, David. So we have all these methods and techniques that we have listed out here. How many of these have you actually used when you used to do inventory management for all the different organizations that you used to work with? Or rather, let me rephrase that. How many of the organizations that you have worked with so far, when when we have been implementing inventory management system or the Deskera inventory management system for them, how many of them were actually doing any of this?
For Deskera, when we were starting up, they tend to be smaller companies, so not very many, meaning they didn't have an inventory. It was like Excel, not really much forecasting, not really having any reorder levels at all, and no real inventory control method. It was more like, we're running low, buy more, running low, buy more. Also, based upon your, the stock levels, they would just go and do manual stock counts at the end of the month, and that would be their stock level that they would just assume. So they didn't keep any real track. It wasn't really systems. But when I was doing with other systems and other implementations with the bigger companies, then yes, they kept track of it. And they had other methodologies such as weigh bridges to weigh the actual trucks going out to make sure the quantity is actually correct, and override procedures and making sure there's stock takes and. But again, even in those cases, I've seen products that have aged quite well. And in those cases, you can see the products actually turning different colors when they're older and just completely lost.
Interesting observation, David. Thanks for sharing. And what we will do is we will look at each of these methods and techniques in greater detail in the coming slides. We will see how to track these values and what do these values mean. I mean, obviously, it's no good to have a number sitting there, in a nice PowerPoint slide without understanding what that number means. So we'll spend some time on that as well. But yeah, I mean, some of these things are intuitive, right? For example, if you want to order, then you should be able to forecast, correct? Because then I mean, if you have a fair idea or a good idea of what your demand is going to be, then you can manage the supply accordingly and you can plan for it. So, but often what we see is that the supply happens after the demand hits, and that is not where you want to be. I mean, that's not planning, that's reacting. And we need to be proactive about it, right? I mean, so inventory control is all about being proactive about your inventory rather than being reactive. And to move away from that, you have these tools and methods. Now, regular audits is pretty straightforward, so we'll not spend too much time on that. I mean, we all know what that means, but you do audit of your inventory stock regularly, right? I mean, that's the first thing that you should be doing. I mean, if you are not doing it, or if you're doing it once a year, you should do it more frequently. What that will also help you with is to understand what are the inventory shrinkages that you are facing, and you won't be hit with a surprise. Plus, you can start looking at different inventory reports on a regular basis, like inventory aging and inventory movement and so on, to get a fair idea of what kind of an inventory is, I mean, which products are working for you, which products are getting sold, which products are not getting sold, and so on. So doing audits and inventory and regular inventory reporting through an online inventory management system like Deskera will help you with that. And the obvious advantage of using Deskera here is that, in addition to inventory management and all the different warehouse and batch numbers and serial numbers and reorder levels and multiple UOMs and multiple warehouses, etc., you also get built-in accounting. So you don't have to have a separate accounting system and a separate inventory system. It all, kind of comes together. David, you want to add to that?
Oh, I was saying that, and that's extremely important.
And that they're all connected together. No matter, with Deskera, it's great because it's all connected there, but whatever system you get, it should be all connected together, because you should not have an inventory system and not being posting journal entries into your accounting system. If it's not syncing together, it's manually done. There's possibilities for errors and issues. And all of a sudden your accounting and what you see in there, especially with LIFO, FIFO, or moving average methodology, it will maybe not show correct, and your P&L may be skewed that way. And then when you get audited, then comes the headache. The auditor's looking at your inventory list and your inventory reports and your journal entries, and everything's not tallying up. And they're pulling out their hair saying, why is this journal that there? And then you don't have an idea why, because you asked your wonderful finance person who's been putting in all the journal entries, and they said, out of the 400 journal entries or 500, why is this one you posted like this? I don't remember. It's important that it's all sung together and it tallies.
Yeah, absolutely. So yeah, having an online system, having an online don't rely on manual calculations or disparate systems that don't talk to each other. That's just going to create more problems for you in administrative tasks and time and project management that you don't really want to spend on, right? Now, let's talk about just-in-time inventory. So just in time is a pretty popular term, and I think everybody has heard about it. Um, David, what comes to your mind when you think of just in time inventory?
Brings up a memory of other companies that we did implementations for they used default delivery in full and on time. So just in time reminds me of that, where you actually, no, it's completely different, but still it just reminds me of that. But just in time means that you have enough the inventory, you get the inventory just in time, meaning it's there and then it goes out. It's not sitting in your warehouse for a long period in time. You're delivering the order in full and on time when the customer wants it, and you're reducing your inventory, the amount of inventory in your warehouse at that level. So that's what it comes into my mind, is that you want to reduce your inventory level. You don't want to have a huge amount in there because it's a cost, as you're mentioning, 1.3 in the United States with trillions. You mentioned trillions of dollars. That's a huge amount of money. Not as big as our U.S. deficit, but still, it's a huge amount of money. So, you want to reduce that as much as possible, get it down to a lower level, and that'll help you do it. And I guess later on, you'll talk about the reordering level and how that helps with the, just in time for that, and match supply, workers, and equipment and demand. So yeah, equipment, workers, so I guess having the proper equipment, having the proper people, having the wonderful vendors with very little lead time or understanding the lead time will help you just reduce that. So at least that's what I get with just in time.
Right. Just in time is primarily about matching your supply and demand so that you keep minimum amount of inventory with you at any point of time. Now, there are different ways to do it, and we'll talk about back order and dropship, etc. As well. But why does it work? How does it help really in reducing those costs? So if you think about the costs that we talked about earlier, so there is ordering cost, holding cost, shrinkage, replacement, and inventory carrying costs, right? I mean, these are the 5 main hidden costs that you want to reduce for your inventory. And if you are keeping your inventory to a minimum by having only some amount of safety stock in your warehouse and everything else you're trying to match to the demand, then you are already reducing the risk of many of those costs that you would be incurring otherwise. For example, holding costs. I mean, if you are not holding a lot of inventory, or if you can reduce your inventory only down to the safety stock that you want to manage, then you don't have to have as large a warehouse. You can actually get a smaller warehouse. So you improve your inventory per square foot, rating or your measure, correct? So, and you automatically bring down the cost of rent and electricity and so on. You have a question, David?
I was just thinking that, and I could be wrong, but I'm just thinking, it could also affect with products that have high fluctuation in price, for example, with a minimum inventory value or anything like that. Because if for whatever reason you buy a large amount of the product or have a large warehouse and it fluctuates frequently, then you may end up with a loss. The value of your inventory may be more expensive than what you can sell it for, or maybe it'll become cheaper. Whereas if you have minimum inventory, you're less susceptible to any type of unforeseen fluctuation. Like, I guess, toilet paper we had during COVID-19 with all the selling and all that.
Yeah. So, yeah, I mean, those are some interesting points, David. And I'm glad you brought up the price fluctuation point, correct? That can work both ways actually if you use JIT, and we'll go into that. I mean, we'll go more into detail we'll go into more detail for when we talk about price fluctuations there. But before we do that, let's talk about how we can do JIT or just in time practically, right? I mean, as a concept it is great, but yeah, how do you do it practically? And the two methods are back order and dropship, right? Now, David, could you explain what is back order and what is dropship?
So inside the system for back order is when you place an order and then you don't have enough stock in order to fulfill it. Then you can place an order to a vendor and then you can top up the stock levels to that vendor. Maybe you can consolidate and see how much stock, how many orders you have in consolidated amount, and you put in your safety stock and you place the order in there to that vendor. Then he sends it to you and then you immediately can go and fulfill it and also maintain your safety stock there. But the main key thing is you don't have enough stock, you place the order with a vendor based upon the quantity you want. The vendor then sends to your warehouse and then you send to the customers. Whereas dropship, the customer comes to you, hey, I want an order. You say, great, thank you very much. Then I go to my vendor. Hey, vendor, how are you doing? Yes, I need this much stock, but I need you to send it directly to my customer. Okay, and then he says, all right. So he just sends it directly to my customer and it never touches my warehouse. It's completely warehouse free.
Yeah, absolutely. So back order and dropship are different strategies that you can use to reduce or minimize the inventory that you're storing and kind of tie in with the just-in-time ordering. Because I mean, with dropship, it is like a one-to-one matching, right? That you are effectively cutting out storage of inventory, just totally, completely, right? I mean, when you get the order, you pass it on to the supplier, who then places the order. I mean, who then fulfills the order on your behalf, and you get the money. So, yeah, I mean, this is like the purest form of just in time. But yeah, there are pros and cons associated with that. And for that, actually, there is. We are doing a dropship masterclass next week, same time, Thursday, 2 p.m. So if you want to know more about dropship and back order and comparisons and more, all the awesome tips and tricks that we have from all the data that we have, then make sure to tune in for that one as well. All right. But yeah, coming back to this, right? I mean, back order is useful if you know that your customer is willing to wait at least for the lead time, or if you have set those proper expectations, correct? So if you have done that, then you can use back order as a strategy. Similarly, with dropship, there are going to be some cons of using dropship. And as long as you are willing to take that into account and cushion yourself against that. For example, I mean, dropship, because it is happening for every individual order, right? What is going to happen is, if there is a price increase on the vendor side, then your margins will automatically go down. If there is, let's say, a shipping incident like Suez Canal, then you're you're stuck, right? Same thing can happen with back order also. So there are external factors that actually can impact this. David, you want to add something?
Oh, I was going to say, just make sure you tell your customer.
We're not liable for force majeure, act of God. So Suez Canal, lightning strike, earthquake, massive fires, floods, rain of fire from God, whatever happens, Yeah, I think everyone will understand that.
Yeah, people understand, but the thing is that, see, there is always an element of risk or a con that you have to be aware of, and you have to plan for it, right? So going completely back order or going completely dropship or going 100% one way is probably not the right thing to do. And we will see how you can actually make those decisions. So if you're selling maybe 100 products, right? You don't want to do back order for everything. You don't want to do dropship for everything. You have to have the right balance. You have to have the right categorization of your products, correct? If you categorize your products right, and you have the right calculations in place, if you're tracking the right numbers, then you don't have to do a guesswork on, oh, should I rely primarily on back order or dropship or some other kind of fulfillment technique. But rather you can make an informed decision, and that is what we are going to cover next. But before we do that, let's look at some of the pros and cons. So pros are something that we have already discussed, that is minimizing inventory holding costs and shrinkage costs, and lower upfront investments, lower recurring investments, right? For example, you will need a smaller warehouse, you will need to hire less people to manage that warehouse, you will need lesser shipping to be done, or less people to ship it at any one point of time, right? So you actually kind of cut down on many holding many holding costs and carrying costs and so on. But what are the downsides? It's absolutely, we need to be aware of that, and we need to plan for it as well. So handling sudden fluctuations in demand, right? If there is a sudden increase in demand, what if your vendor is not able to match that, right? Then it kind of breaks down your linkage between supply and demand, and then all of a sudden you have customers leaving you because they can buy that from some competitor because you are not able to fulfill that order. Why? Because the supplier doesn't have that item with them right now. So that is something that you have to be aware of. Then obviously supply chain volatility or fluctuations in supply chain, right? External factors, right? They can impact. David, you wanna?
Oh, I was just thinking, I was hearing that.
I was hearing that supply chains are moving closer to other cities and locations, and moving closer because of COVID and because of all this recently. So they were talking in the US that a lot of companies are coming back, manufacturing companies, to produce goods there. But of course, all automated and stuff to reduce the costs in order to shrink the supply chain route down there. But yeah, you're 100% correct. I'm thinking also fluctuations in demand. That'd be horrific in dropship cases. You say you place an order with a vendor, the vendor says, unfortunately, we're full for the next 3 months. Please come back then, or something like that. That'd be awful. And yeah, supply chain, already. So that's what I was just thinking if they were talking about. I don't know if you heard anything like that or anything in this, like in the US, masks were not produced, drugs were not produced, all this not produced. And now they're looking at shrinking the supply chain down and doing stuff like that.
Amazon is an excellent case study for anybody who's interested. Maybe we'll do a video or a session on how Amazon manages inventory. But the real success of Amazon is not because of their website, right? The real success of their e-commerce platform is not because of the website, but rather because of the fulfillment that they are able to achieve, correct? And that is primarily down to these massive fulfillment centers that are all across the US, right? And the kind of technology that they use in those fulfillment centers to quickly get the items in and immediately ship them out, right? Tracking it, etc. That is the differentiator between Amazon and other e-commerce competitors in the US, at least, right? We'll probably do something about that. That's a good thing to study and analyze and learn from, especially if I'm doing inventory management. So that's a good thing to do. But yeah, having those fulfillment centers closer to your point of delivery is going to make a big impact in the customer perception of your brand, correct? Obviously, not everybody can do that, but you can always utilize Amazon for fulfilling, right? There are Amazon allows you to use their fulfillment centers. It's a shared service, like kind of AWS now. So they started AWS for their use, and then eventually they started loaning it out to people, and that is how AWS became the behemoth that it is today. And the same is happening with their fulfillment centers. So yeah, that is one of the things that you can actually look at if you are operating in a region where Amazon runs a fulfillment center. And there are other e-commerce players who are starting to do the same as well. So yeah, that's about JIT. But one point, that we talked about in JIT was that, you have hundreds of products, right? So should you do back order for everything or drop ship for everything? Should you do these experiments immediately and then learn from that? Or is there some theory, some rules or guidelines that we can follow to decide that, okay, which products should have more focus and which I don't need to worry about so much. And that is what we will understand now as to how to do that demarcation, that distinction, that categorization of the products that you're selling. And we will look at what are some industry specific standards around those numbers as well. So the first analysis method or technique that we are going to talk about is the ABC analysis. Now, many of you would have heard of the Pareto principle or the 80-20 rule, correct? ABC analysis is an extension of that for inventory management. David, have you heard of Pareto or 80-20 principle?
80-20,
I've heard of 80.
So what's your understanding of that?
What's it called? Oh, it's more for projects. 80% of it is done then, and 20% is not. We go live, or we look at going live for the bigger implementation. Get us close to 80% done, and then let's go. We can get the 20%.
So one because you mentioned projects, so one example that I can think of is that 80% of the work in a project is done by 20% of the people. So so that is there. But yeah, I mean, basically 80% of the outcome is dependent on 20% of the input, or 80% of the results are because of 20% of the resources, and so on. That is the 80-20 rule. I mean, obviously it doesn't hold. I mean, it's not a law, so it's not like it applies to everything. But yeah, that is what you call the Pareto principle, right? So, for example, right, 80. If I am running a customer support center, right, then 80% of the customer queries would be because of 20% of the features, and those 20% of the features are what you would focus on to keep improving, enhancing more than the other 80%. So again, this is a rule of thumb. It's a principle. It's not a law. So please be aware of that. Now we can do something similar for inventory, which is basically called ABC analysis. And what we do is that we look at inventory from a consumption perspective. How fast is your inventory getting consumed? Which is effectively another way of saying how fast you are selling your inventory. Now, how do we do ABC analysis for inventory? Is that first you look at the annual consumption value for each product that you have. And then you create a table. And then you look at the cumulative consumption value for each item. Now, once you have this list, you sort it by the consumption rate. And more often than not, what you will see is that 70% of the movement is happening because of 10 to 20% of the item. So the top consumption rates are going to be, or the top consumption values of products will be distributed in the ratio of somewhere close to 70, 20, and 10. Or you can choose to break this list into 10, 20, and 70. And immediately you will know that, okay, these 10% of the items are responsible, or these 10 or 20% of the items are responsible for the maximum consumption, whereas the rest are not getting consumed as well. It's an important first step, because this tells you or gives you an indication of what your most valuable products are. And for those products, what you would want to do is you would want to have stricter inventory control procedures in place. Now, why do we need to do this classification in the first place? Because everybody has limited resources. Nobody has got infinite resources, infinite time, infinite money, right? So you want to focus on the most important inventory items in your portfolio, correct? And start getting rid of the ones that are not doing so well. And that is what you can achieve with ABC analysis by breaking it down into 10, 20, and 70 based on the consumption value or the annual consumption value for each individual product. David, any questions? Or do we have any questions on this?
Oh. Yes.
So what about this concept? I mean, do you kind of get the concept here, right?
I do get the concept. It's quite interesting.
Thing though, in that aspect, the 10% of the goods and the 70% of it not being, not moving or very slow moving compared to 10%, 20%. Do you have a question?
Okay, so we have a question. If you are selling a bottle of water, which is made of water, bottle cap, and label, do you suggest putting small consumables such as label as inventory or supplies expense? So, now, very small consumables which don't add a lot of, I mean, which you are not spending a lot in terms of inventory cost that we saw earlier. For example, if you're not spending a significant amount of money on holding that inventory or ordering that inventory, etc., all the associated costs, right? If they are not adding up to a lot, then you can just put them as expenses. But if those additional costs by themselves are a significant percentage, I would say maybe 5% or more, then you would want to keep them as inventory items because they are contributing to your overall inventory valuation and inventory costing and cost of goods sold there. Sorry. Right. So yeah, let's look at the next question. Do we deduct the defects from refund from COGS? So what we are talking about here is that, okay, I sold something and then that item got refunded, correct? And then there would be a cost associated with that. But because there is a refund, do I remove that from COGS or not? Typically, no. David, what would you suggest?
I was just thinking.
You refunded the product. Are you returning? Is the product getting returned back to us or not? And then that becomes an additional cost for that because the cost of sending it back. But the refund itself, would that be on it because you're just giving them back their money? They're not, because you paid it and you're refunding them back their money. So it's just balancing it out, right? Because I received their payment, I got the money, I did my journal entry there, then I refund them back. I'm just doing the basic journal entry. The only cost on that product would be sending it back to yourself, unless you're giving it to the customer and disposing of it, meaning it's too expensive, you're going to keep it. Or if it's a partial refund or you're refunding partial, then it'll affect your cost of goods sold because the amount that you're selling would be reduced.
Yeah, so it's going to, I have not seen a lot of companies putting refunds under cost of sales. Why? Because refunds is something that is happening after sales. So while it is a cost to you, it is not a cost of sale. You have already made the sale. And refunds were not a part of the sale process, right? So it's not considered, I mean, you would typically not put it there, correct? I cannot think of the top of my head of any scenario where you would, but there may be a few scenarios maybe where you may want to include there, but I can't think of any. So my answer would be typically no, because it was not involved in actually making the sale. That is happening after the sale. A refund is going to happen after the sale, so that you can put it under your other expenses or other things, right? But not under cost of sales typically. Yeah. Let me. Better. All right. Do we have any other questions? If not, then we can move to ABC. So do you have?
FIFO.
Oh, FIFO. Okay. Thanks, Leonard. So FIFO it is then. We'll use FIFO then. Okay. All right. So yeah. So coming back to ABC analysis, right? Um, I think this will be clearer once we look at ABC as well as FSN. And then the same method that we use for ABC will be used for fast, slow, non-moving, and then you can combine the two. But yeah, the idea is this, that step one, segregate your inventory by consumption, by the units being sold, and the value of the units being sold. This is like the absolute first step, right? That you should know what your more valuable products are. If you don't, then you might be spending a lot of time and money and energy on trying to manage a product that you shouldn't even be keeping in the first place. As Peter Drucker said, there's nothing more regretful than doing something very well that which should not be done at all. So yeah, I mean, same applies to inventory, right? So yeah, I mean, absolute first step, segregate your inventory into ABC, know what your top performing products are, which are not so well performing, and which are absolutely the things that you don't want to keep, and then start getting rid of them. Start compressing your product list. Then the next step would be doing an FSN analysis. So what is FSN? FSN stands for fast, slow, and non-moving, right? How do you do this though? Correct. What you do here is that you do a fast, slow, and non-moving analysis based on two parameters here. Basically, it's something similar to ABC, but you first rank all your items or products based on the average stay. What is average stay? Average stay is the amount of time that you have, the total amount of time that you have the inventory staying with you in the warehouse divided by your total inventory that you had. So let's say that over a period of an year, you had purchased 50 items and you already had 50 items in the inventory, and the time it took for you to clear the entire thing was 300 days. So your average stay would be 300 divided by 100, which is 3 days. That one item on an average was staying in your inventory for 3 days. So that's what average stay is. And then the other parameter on which you can rank or categorize your products is the consumption rate, which is basically total sold quantity divided by the total duration. So if in a period of 300 days you sold 500 items, then your consumption rate is 500 by 300, which is close to 1.7 something, right? So basically you are selling 1.7 units per day, and you get these two numbers for every single product or item in your inventory list. You put it in a table, and then you categorize them as F, S, or N based on the section that we have here on the right. So if you are looking at based on stay, right, then based on average stay, 10% or less of the average cumulative stay is going to be classified as F, or fast moving products. So let's say that my average is 10 days and I have products that have got the average stay of less than 3 days. Then those products will be classified as fast products against my total average for all the products. Similarly, for the next 20%, you can classify them as slow. And for the other 70%, you can classify them as non-moving. And that is one table that you would create based on the average stay numbers. Then you would create another table based on consumption numbers. Obviously, I mean, If you have a high stay, then that is bad, and high consumption rate is good. So you just need to be careful when you are ordering, that you order it in the right sequence, and then do the same exercise for consumption. Let's look at how it looks like when you actually do something like this. So here is an example. On one side, we have the same set of inventory items uh, sorted by stay versus consumption. And you can see that now I have a matrix here. Now, David, when you look at this, what are your first few observations?
Item code 7 has an average stay of 12.45. So it looks like it's
Staying a lot, it's not moving very quickly. So I can easily see which ones are my slow moving and fast moving here. Like item 4, only 3.63. Well, my consumption is also goes hand in hand. So my average stay being reduced is also showing that my cumulative average stay is also going increase. So it looks like my consumption looks like it's going up based upon my average stay. So my average stay is low, my consumption rate's going up. It looks like, I'm not sure if that's a parallel or a correlation.
Typically, they would correlate, but it is not always necessary, right? You can have items that are getting consumed at a faster rate than an item that is staying for a smaller time. I mean, just look at this list, right? So 0, 1 and 0, 4. So item code 0, 1 and 0, 4, right, are the fastest moving based on stay. But when you look at the consumption rate, correct, then they are not the top two. They are now number 2 and number 3, whereas 10 goes to number 1. And if you look at the number of fast moving categorizations on the based on the consumption rate, you will find a lot more Fs there, or a lot more fast moving items based on consumption. But if you look at FSN classification based on stay, you will find only 2. So there will be some items that are probably classified as slow or not moving based on the average stay, but they are classified as fast based on consumption rate. Why would that be? Because you may have items that don't get sold very often, heavy equipment, machinery, but your consumption rate or the consumption value for those items would be extremely high. So it kind of offsets the time that it spends in your warehouse or your inventory. So high value items. I mean, Rolex watches don't sell like hotcakes, right? Only hotcakes sell like hotcakes. So, I mean, a Rolex will stay for a long time, but when it is consumed, the value of that consumption is going to offset my holding cost, right? So you have to look at both the value of the sale being made and how quickly it is being sold out to arrive at the proper classification of your products. If you don't do both, then you may end up making some really bad decisions, which you don't want to do, right? So otherwise, everybody will be selling hotcakes and nobody would be selling, Rolexes anymore, because they sell like real fast, right? So
unlimited hotcakes and so it's great.
yeah. So yeah, I mean, so that's why it is important to do this analysis for both stay and consumption value and consumption rate, and then combine them together. And how do we do the combination? So here we map out the consumption rate classification and the average stay classification, and then we do a final classification based on the ratings that a product has for both. The rule of thumb to follow is that if it is, I mean, you have fast, you have slow moving, and you have non-moving, right? So that's the grade that we are following here. So if something is fast in one category and slow moving in another, we always go with the higher categorization. All right. And if something is fast and non-moving, then we go with the average categorization, which is slow moving in this case. And that is how you do your final FSN classification, and that will give you a better insight of which products, which items that you are holding need more inventory control, uh, closer inspection, more audit, um, and which ones you don't either want to keep or you can let them be. Correct. If something is high on both consumption and stay, then it means that these are high value items that are moving very fast. So you want to have a really tight control on, these items in terms of managing the vendors associated with supplying those items, managing the supply chain more closely, looking at market events, doing better forecasting or putting in efforts to do better forecasting for those items, uh, versus something that is, slow or not moving. So that is how you do FSN analysis. Warm water. Thank you.
So,
Yeah, go ahead, David.
what do you do?
For the non-moving products, meaning FSN consumption rate is not moving and average stay is not moving, do you start to look at maybe getting rid of these products, or?
Absolutely. So there are a few things that you can do, right? One is that you need to analyze, okay, why is this not moving? Maybe it is, I mean, if I'm a retail store, correct, then I may have kept them in some godforsaken corner of the shop where nobody goes, or where it is, extremely cold and nobody wants to go and spend time looking at the different items there, and they quickly move away from there. Maybe it is not moving because of that, or it may not be moving because it is not a product that people want to buy. I mean, it depends, right? You have to further analyze. It's not just that you make decisions based on these numbers. These are not decision, I mean, these will help you make the decision or start on that process of finding out why something is not moving. But to know that, if I want to solve a problem, first I have to know what the problem is, and this tells me exactly what the problem is. These goods are not moving. They are neither being consumed, they are not giving a good consumption value, nor are they moving off the shelf quickly, right? So now that's a problem that we have to solve. There are multiple ways to solve it. I can stop buying that item altogether, remove it from my portfolio, or I can maybe try a promotional scheme on that, start giving more discounts on it, see what is, talk to customers who you think are the right customers to buy that, and understand why you are not buying this product, and then incorporate that, right? Maybe look at the layout of my store, correct? Maybe it is on my website but it is on page 24 and it has got really bad SEO, which is why nobody is able to search for that product. You never know. There could be multiple reasons for a item or a product being non-moving, but knowing that is the first step to discovering ways of improving the outcome eventually, right? Now, next question is, now okay, I have got my products, everything done properly and everything, right? I know what my fast moving products are, slow moving products are, non-moving products are, etc. Now I want to do closer inventory control of these products. But how do I do that? And the first question that comes to everybody's mind is as to when I should be placing my order. Why? Because if you don't place your order on times, then you end up with stock shortage. And what does a stock shortage mean? It means that your customer is going to go to your competitor to buy that item. And you don't want that to happen, obviously, right? You want to have stock in supply to be able to provide to your customer. And reorder point is the number or the calculation that will help you do it properly without having to do any guesswork around it. So, David, so we have a chart here, like a small chart here, right? Which is the reorder chart. When you look at that, what are your first few observations?
Reorder quantity, the what's it called? E is what I see here, right? It says I see the reorder point at A is somewhere in between, and I see the reorder quantity there, and it looks like it's in between the reorder point. And I can see the safety stock there as well. So the safety stock and the lead time. So we have quantity by time, and we have this area here. So it looks like the key thing is making sure that you have a reorder point, you're alerted that there's a reorder point, and that you reorder, and based upon the lead time as well. It's very important, because if it takes donkey years, you have to order donkey years in advance. If it's very quick, then it's very quick.
Right. So what is reorder point here? I mean, what is the objective of having a reorder point in the first place? Your inventory is getting consumed, and the objective of having a reorder point is to stop the inventory from going below a certain point, what you would call your safety stock, right? Now, what is safety stock? Safety stock is basically the stock that you keep always at hand to account for any fluctuations that may be happening on a day-to-day basis, right? And this is something that you can arrive at by looking at your previous data, by doing forecasting. And there is a small formula for that also, that whatever max daily orders that you get multiplied by the max lead time minus the average orders. And so the difference between your average orders that you get and the max orders that you get is your safety stock. Because so for, I mean, if you look at your previous year and you see that the maximum order that you got on a daily basis was maybe 50 orders, but on an average you sell maybe 20 per day, then 30 is your safety stock. So because chances are that when the fluctuation happens, it will happen somewhere towards the max value only, right? And hence you have that safety stock to account for that fluctuation at any point of time. This is obviously something that you would do for providing better customer service and making sure that your customer doesn't go back, correct? And what you don't want to happen is for your stock to go below your safety stock at any point of time, ideally, especially if it is a fast moving stock or a category A stock, right? And reorder point is what will help you determine that point, that okay, if I have a safety stock of 30, then when should I order or place my order so that by the time I get to my safety stock, my order has arrived into the inventory, into the warehouse from the supplier. And that is where the concept of lead time comes into play. What is lead time? Lead time is the time on an average taken by your supplier to ship the goods to your warehouse, to your stores, right? And how you do the calculation for reorder point? You first calculate your safety stock, which is basically the variance between max and average. And then you look at your daily consumption, you multiply that with the lead time, which will tell you the shortfall that you're going to face from the reorder point to the safety stock. And then you add that to get the reorder point. And what this will do is that by the time your stock, as soon as you hit the reorder point, you will place the order, which would be the reorder quantity or the ideal quantity. And we will see how to calculate that as well, right? You place the order for an amount of stock. And then by the time you go from reorder to your safe stock level, you already have your reorder quantity coming from the supplier to your warehouse, and then you kind of repeat the cycle. And this way, what you do is you ensure that you're not ordering too quickly or too late. If you order too quickly, then what is going to happen? You will have excess inventory sitting in every cycle. And that excess inventory is going to slowly add up. And eventually you will have excess inventory that you are not selling, and it's just going to add to all those various hidden costs and everything that we learned about earlier. And if you order it too late, then you will be going ahead and dipping into your safety stock, and chances are that if there are any fluctuations, you will not be able to meet them, and therefore your customer is going to be lost because they will just go and buy the item from a competitor. So that is how you use reorder point. Now, obviously, the question is that, okay, how much do I order? Right now, I understand the reorder point, which is when I should place my order. Correct. At what stock level should I place my order? And then the next question is how much should I reorder, or the reorder quantity. Now there are different schools of thought around this, right? But the ideal reorder quantity that you should go for, without looking at any other thing, is just your consumption time, your daily consumption rate into the lead time. Correct. Because that is what you are going to refill. Correct. And that is what will be reduced by the time you get to your uh, reorder point again. However, there is something called the economic order quantity that you want to take into consideration when you are ordering items from suppliers. And that is the next thing that we are going to jump at. Now, why do we need economic order quantity, right? What is EOQ? Correct. EOQ is the optimal amount of inventory for which you should be placing an order, or the optimal order size, so that you do not end up incurring a lot of cost. Now, let's look at this graph, right? So here you can see that your total cost is typically a combination of two separate costs: the holding cost and ordering cost. Ordering cost, as we saw earlier, decrease as your volume increases, but your holding cost increase as the amount of inventory that you have increases. The more inventory you have in your warehouse, the more the holding costs are going to be, because you need a bigger warehouse space, you need more people to manage it, more additional expenses, etc. Right? So now that we understand this, right, you see that the total cost is something that goes down first, because your ordering cost is going down, but then the holding cost will increase, and it will kind of cause a inverted U curve or an inverted parabola, which will have a point of which will have a minimum point somewhere, and that minimum point is what you want to determine, where your cost is lowest. David, what are your observations here by looking at this? And I mean, how? What do you think? I mean, does this make sense to you?
It does. It's just
That it's interesting. The EOQ is actually above where the holding costs and the ordering costs intersect. It's not directly on that line for that amount. So it looks like the total cost. So the total cost is the lowest point, but the ordering cost and holding cost intersection. It's interesting.
Yeah, because
So-
the EOQ is the reorder quantity, which is actually on the x-axis. So it doesn't matter where it is on the y-axis, because you're looking at the x-axis value, correct? Where you are getting the minimum, the right combination of your holding cost and ordering cost. Wherever these two intersect is typically where you would see the minimum cost being acquired, correct? Now,
I was curious if this takes into account also the how fast it's moving and the amount of quantity that's per day and all that as well. I guess because the holding cost and ordering cost.
get to the holding cost and the ordering cost, right? I mean, you will calculate the holding cost and ordering cost based on that. Now, obviously, you cannot sit around plotting this and trying to figure this out, manually, right? So there is a formula for that, and the formula is uh, root of 2 multiplied by d multiplied by s divided by h. Now, it's slightly, I mean, non-intuitive, but it is something that you would want to look at to optimize your order size. Because if you do that, then you're automatically cutting down on a lot of extra costs that you might otherwise incur and reduce all your impact on increasing inventory costs because of holding and ordering and so on, which is one of the main reasons of increasing inventory costs and therefore reducing profits. Correct. Now, what are these things? D is the annual demand or the demand that you have for that product. S is like your total ordering cost, which we would have calculated based on your shipping cost and freight cost and duty, etc. And then H is the holding cost, which is basically once the inventory comes and sits in your warehouse, then all the different costs, which is like warehouse rent and electricity and labor, etc., which is spread over your entire inventory unit or the number of items that you have, which is the average inventory holding cost that you have. And when you take all of this together and you put it into this formula, then you get the economic order quantity. So what the EOQ does is it finds the right balance between the holding cost and purchase cost to give you the right order size, which will allow you to minimize your inventory acquisition cost and inventory maintenance cost. Correct. However, you also would want to keep into consideration the lead times and consumption rates, and you should use EOQ as the reorder quantity if the rate of consumption divided by if the economic order quantity that you get by this formula is when it is divided by the consumption rate is approximately equal to the lead time, which is what we thought to be the reorder quantity earlier. Correct. So if there is a small difference, let's say a difference of up to 4 to 5%, then just go with the EOQ. Correct. If the EOQ is way lesser than reorder quantity, then you will start falling short of stock. And if it is way too high, then your reorder point will start fluctuating. So as long as you stick to EOQ, right, just make sure that it is not lesser than your reorder quantity, because if it is lesser than your reorder quantity, then you will start facing stock shortages like real soon. But if it is greater than or equal to your reorder quantity, then you should always use the EOQ as your reorder quantity instead of doing a direct consumption into lead time calculation, because then you will be minimizing your cost as well as ensuring that you never fall short of stock. All right. So let's see if we have any questions so far. Okay, great. So no questions so far. And so yeah, with that, we move to the next topic, which is inventory turnover ratio. Now, what is inventory turnover ratio, or what comes to your mind, David, when you think of the term turnover?
My stock is moving, how I'm turning it over for a profit or making money. How quickly can I make money off of this stock? Is my turnover ratio high? Can I turn it over and make a profit quickly, or is it a very slow process, or am I not very little? For example, I'm just thinking, the average inventory I have in there is 50 or 100 or something like that, and the cost of goods sold is so much, and then it tells me how much it is. At least that's what I think. But I know you're going to tell me, so that way we're going to know exactly what it is. I'm looking forward to that.
Right. So yeah, inventory turnover is a measure of how quickly you're selling and restocking goods. So you're absolutely right there. Correct. What is, but like, every other thing in life, too much or too little is bad. What you want to do is you want to strike the right balance. All right. If you see numbers skewing to a very low value or a very high value, then you should double check as to what is going on, right? So before we go into that, let's quickly look at how it is calculated. It is calculated, it's quite simple. It's cost of goods sold, which you already know how to calculate, and it is divided by average inventory. Correct. Cost of goods sold is basically a measure of how often you are selling items, right? And obviously, this is for a certain period. So you want to look at this number for a month or a quarter or a year or something similar, right? And typically, an inventory turnover ratio, or this number, which is cost of goods sold divided by average inventory, as long as it is between 4 and 6, it is considered good. Some industries, 5 to 10 also is considered good. I mean, again, there will be some industry specific variations, but generally, if you are in 4 to 6 range, you are in a good spot, right? I mean, obviously you want to keep increasing this gradually, but not at the cost of inventory shortage, right? I mean, because like with any other ratio, it has got a denominator and a numerator, right? So if your average inventory starts going down, then this number will shoot up, but that's not a good thing, right? Because it means that you will not be able to meet customer demand, correct? So if it is shooting up because of high cost of goods sold, that also by itself may not be a very good thing, because that may mean that your cost of inventory has gone up considerably. So you want to understand the reasoning why this number is going high or why this number is going low, right? But as I said, typically, yes. I mean, 4 to 6, if you are, then you're doing pretty well. What it means, 4 to 6, is that you are restocking your inventory every 2 to 3 months, typically, right? I mean, if that is good for your business, then yes, you're doing good. As I said, business specific, if you're selling hotcakes, then you should be doing it every day, right? Otherwise, every 2 to 3 months, if you are doing a complete refurbish of your stock, then you are in a healthy spot. But you should always try to improve that, while keeping in mind that you're not improving it by or at the expense of buying or at the expense of shortage of stock or an increased cost of stock. David?
No, I'm just thinking.
Cost of goods sold and average inventory. It does not matter the 4 to 6 based upon your method, meaning FIFO, LIFO, or average moving. It wouldn't matter, right? Because your inventory would be affected the same as your cost of goods sold would be affected.
Correct. They will impact the value of the cost of goods sold, but they will not impact this ratio. So it doesn't matter what calculation method you use, you will end up with the number here. I mean, obviously the cost of goods sold value will change. So in a way, yes, it will impact, but the ratio itself is not defined by what method you use.
4 to 6 is good.
Yeah, I mean, as I said, depends on the industry. I mean, if you are selling hotcakes or perishable items, then you want a very high. I mean, even then, if it is going very high, then it means that your cost is going super high because your inventory is going to be low because you're consuming your inventory fast. All right. So with that, we come to the end here, and we had kept this time for some questions, but we have kind of addressed the questions earlier. So thank you so much for being with us today. And please don't forget to like and subscribe the channel and the video. We are going to come up with more updates soon on drop. I mean, there are so many updates happening. There is a training session with David on Tuesday that you can be a part of and ask him questions directly on how to use Deskera. Then we are going to do a lot many more masterclasses. We have a dropship masterclass coming. We have a joint event with SMCCI coming up in July. So make sure you have liked and subscribed to the channel so that you get the updates in real time and you can get reminded when we go live next. And David, thank you so much for co-hosting the session with me.
Thank you. And take care, everybody. Have a
Wonderful evening or day or night, wherever you're located. Take care.
Wonderful. Have a good day.